Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We're going to hit up Twitter today. I'm going to give you my financial opinions across the board on a bunch of financial, wealth building, and commodity related topics. We do have a Sunday platinum question and answer session at 7 a.m., which this is going to be released at. So don't forget to sign in. Don't forget to join the meeting if you are a member. That's finding-value.com over there. And you can use the word discount in the coupon code if you want to join. We've got, again, if you want to follow me, it's at Funding_Finance on Twitter. This is Huntington Beach in the background. I used to live in Huntington Beach. I did not take that picture. I grabbed it off the internet, but I used to live out there. Just an FYI. Ferg says commodities are 50% cheaper than their lowest point in 50 years and would need to outperform financial assets by over 700% just to reach the long-term mean. That's from where we are today to the mean, not the overvalued state. That is to the mean. Generally speaking, whenever you swing to the bottom and the more extreme you go to the bottom, the more extreme you're going to go to the top. I think that this is a ridiculous setup for those that are long-term investors that are patient. Why do I say that? Because impatient people are not going to be able to ride through it. This is just buy the asset, wait for a period of time, and it should appreciate over time because this is the by far undervalued sector. And it's not just undervaluation. You've got capital hasn't gone to this sector because of how low this is. And it will take a little bit of time for all of this to reverse. This one from bottom to top, it was 1999 all the way to 2008. So it was a good almost 10 years, about 9 years, 10 years, 9 to 10 years for that to occur. Also in the late 60s all the way to 1980 was another 10-ish year decade for commodities to really take off and outperform stocks. Stocks are still incredibly expensive. Commodities are still incredibly cheap. It will probably take a decade for this to unwind. That is generally what it's taken in the past. We also had in the 1980s to 1990s, so that was a little bit quicker one, maybe 5 years for this one. That was kind of, we came up, came back, did the Batman pattern, and then blew out to the downside. So we're very cheap right now. That's where we're at. Tavi says, after being down 45% from its recent highs, the risk reward to buy oil today appears heavily skewed towards the upside. Excluding the outlier event of the pandemic crisis, we can observe two types of pullback in oil price over the past decades. The GFC and the 2014 energy market meltdown resulted in an average decline of approximately 75% from peak to trough. During the tech bust, the decline was close to 50%. In the current environment, we believe there are strong similarities to the early 2000s period, particularly in terms of historically depressed capital spending. Despite the risk of demand shock, which mostly already largely reflects in the current prices, oil supply remains incredibly tight with production still below pre-pandemic levels. Not to mention, unlike a year or two ago, the government has already depleted its strategic petroleum reserves to levels not seen since the 1980s. We look at the history of the pullback in oil prices. We have a historical low back here in the early 2000s. Now, this is when the commodity to stock ratio that Trader Ferg was showing was positive. It was 98.99. That's where I would have purchased. Now, what people are going to tell you is this: it's going to roll on up, and they're going to see this first. So this is the first wave here. This is your first wave 2 pullback, your first pullback or wave 2. This is the bull. This is the bear trap right here. People are going to say that you're wrong. They're going to say, oh, it's pulled back 50%. We're not in a bull market. But we are in a bull market. It's this move here is the same move that this is here. This first pullback, 45% where we're at, is the same as this 50% pullback here. The third wave is this wave here, and then we get a last fifth wave. And then we go to a consolidation period. This consolidation period here is your recovery phase of real estate. This is the expansionary phase of real estate, recovery phase of real estate, and then we're back into an expansionary phase. That's the credit driving the prices of oil. This here is your bull trap. This is a bull trap. You come down and then you just get absolutely smoked to the downside. So you have the consolidation. Some people think that this is wave one here. This is a pullback in wave one, all the way back, and that this is wave one of the third leg. So wave one, you project upwards, you pull back, then you do a fractal analysis upward, and you get gigantic numbers to the upside. There's other people looking at this through the Kondratiev wave, and that's basically what they're using, the K wave. This is wave one of a very big third leg. Bottom of the third leg is here. So this is wave one here. This is wave two. And this is wave three that goes all the way up to, some hundreds and hundreds of dollars. 250, 300, 500. I don't know the exact top. We'd have to price it out here, but it's probably like something like $500. That's my guess. So there's that going on there with oil. And that's going to apply across the whole commodity complex, what I just said of that fractal. It says China is the key consumer of industrial metals. It accounts for over 50% of copper's global consumption. China is the biggest consumer of industrial metals. We've got aluminum at about 60%, copper mid 50, 55%, lead around 50, nickel 56, tin around 50, and zinc around 50. So that's what they consume on a global consumption basis of these industrial metals. All a little bit over 50%. Peter Spina says gold will be the cornerstone of trust needed from the BRICS eventual new monetary system. Gold is a premier currency that no fiat currency, including the dollar, can match. So what he says for Alan Greenspan is, remember what we're looking at. Gold is a currency. It is still, by all evidence, a premier currency that no fiat currency, including the dollar, can match. I know some people probably aren't happy with the word currency that he used. We probably would be more happy with gold is a money. Everything else is a currency. And gold is a premier money. Okay, we get it. Coming on down, Brazil is the world's new agricultural superpower. The emergence of massive trade surpluses over the past decade isn't about oil, which is in the red. Instead, it's almost entirely about agriculture, which is in the orange, which I would say is the yellow, but okay. With a big chunk of those agriculture exports going to China and the rest of LATAM. So you can see over time that agriculture is actually making up a larger and larger percentage of Brazil's trade surpluses. You can see fuel and lubricants and other in the blue and red at the tip there, and the majority of it is agriculture. Steven Stop, and I can't pronounce that, but the U.S. will be supplying about a quarter of the world's LNG by 2030, according to Willingents. I don't even know what that is, but the U.S. only began exports in 2016, so that's a big jump. Rising global demand for gas is helping to underpin several new export projects across the U.S. Gulf Coast. Percent of global LNG supply by country and type. We are going to see a gigantic boom in LNG from the United States. You can see from 2022, we kind of go flatline here in 2023. And then in 24, we start increasing our exports of liquefied natural gas. Now, if you dig into some of the presentations for natural gas producers, some producers are projecting that we are going to peak in natural gas production in America in 2030. That's what they're projecting. Is that true? Is it going to happen? I don't know. But that's some data that I read of some of the companies that are projecting a 2030 peakish, somewhere in that range. It says, here's a riddle. If Redfin says rents are down over the last year, how did the Census Bureau survey come up with median asking rents rising from $1,255 to $1,462? A 21% jump in 1 year from one data source. outright declines from another. I have a theory, but I could be wrong. This is the median asking rent for vacant rent units, 1255 to 1468. And perhaps someone is measuring median asking versus median closing rent. That could be a difference, but let's see what his opinion is. It says, let's associate rent with apartments and own with single family homes. But now we have this funky situation where a ton of people own houses with 3% mortgages, and they're reluctant to leave that low rate. Some of them choose to become amateur landlords. Maybe their house is one of 20 homes on the street, every single one owner occupied. Suddenly, this owner is listing a big 4-bedroom house for rent. I think it's much simpler. I think that one is an asking rent and one is a closing price rent, or something that has been rented for a certain price. So think of whatever's on the books for that rent that went through. So you can ask what you want, but that may or may not be what gets closed in the deal or the agreement. Valeris thinks we need to see day rates at 1 million to promote ordering in the offshore rig sector. It would require 3 years at the yard and at least a 5-year contract. Nobody is willing to commit for nearly 10 years right now. And right now, the day rates, depending on what it is, 300, 400, 500, 600, somewhere in that range, is where a lot of these are getting contracted out at. They're thinking a million plus to even promote ordering in the offshore rig sector. Lots of upside left for that sector. We've got natural gas clearly bottoming, and that is TTF natural gas. So we basically created a little pattern here that we just absolutely smashed to the upside. We've come all the way back and retested that breakout point. That is generally where I like to buy. I'm seeing these types of patterns across the board. Fertilizers have it. Coal has it. Natural gas has it here. Oil has it too. It's just on an angle to some degree. A lot of commodities have this breakout return move, and then I think we're going to see a big move to the upside whenever it decides to take off. Nickel also has a pretty long-term chart. If you look at it from this perspective, if you draw a trend line through here, is this a double bottom? He says double bottom resting on the upper golden trend line looks strong to me. We'll see where this goes. It does have a nice little green candlestick right on the support level. We'll see if that thing holds. But that's nickel. We've got coal here. I talked about coal breaking out and then coming back and doing a return move. That's what we're doing, is we're doing that return move right now. It says if we get a 20% drop in coal, the buying opportunity is massive. Totally agree. We've broken out of these big long-term bases. They come and have done their retest or return moves. That is where I load up. That is where a lot of people should be loading up if you follow and prescribe to technical analysis. And the ratios are all cheap too. Nat Gas is doing it as well. You can see Henry Hub natural gas. You can see the breakout. So you have downtrend line. We got the breakout. We've come all the way back and doing a retest move probably here, where we'll eventually launch to the upside, hopefully. SRS. Unfortunately, Nassim doesn't understand the falling energy return on investment of oil or the thermodynamics of oil depletion. The world has hit the Red Queen syndrome as the global oil industry natural decline rate is now 10 to 11 million barrels per day lost every year. Also, global GDP is based on a 1-to-1 ratio of energy to GDP. Why do finance and economists ignore energy in their forecasts? Likely because they believe in energy tooth fairy. So what he's saying is we can see as the global oil production goes up, your annual decline rate on that global production is going to decline, and it's increasing as a percent of production. The decline rates are getting more aggressive, put it that way. And here is the 1-to-1 relationship with GDP growth. That's your R squared value, and basically describing out the more GDP you need, the more energy growth you need with it on a 1-to-1 relationship. So many people have been hurt by doomers. If a doomer hurt you, please leave a comment below as maybe some of the sheep will see it and you can save them from the pain. I like this, guys. All right. I used to watch Reventure Consulting when I did not know anything about real estate. I admit following him really hurt me, and I eventually, after watching this channel and seeing him make bogus predictions, realized he was full of crap and just making content to feed off of people's fear. Getting wealthy is hard work, and he just promotes wait and let prices fall. Everything is easy. Well, that's one opinion, which probably matches mine. Patrick Karam says, alert, massive 12-year base close to final breakout. Where do you think gold and silver are heading if the Swiss franc breaks out? Rocket ship time. 12 years in the making, bigger base, higher in space. We've got a breakout line here for the Swiss franc distance from the 5-year moving average. We're starting to break out right now. The Swiss franc, it is a currency that we can use and measured against the dollar. Remember monetary tightness and monetary weakness. Gold and silver do really well when interest rates fall and the dollar falls with it. Those two are interconnected. And what happens is other currencies will strengthen during that time frame. So we'll see the Swiss franc strengthen at the same exact time that silver goes up and gold goes up because the market conditions are ripe for those two to go up together. So what you can do is you can analyze certain currencies and see how they are doing and overlay it with silver or gold or some of these other ones to see, are all of these showing a breakout? If they're all showing a breakout, what that does is it gives you greater evidence for the potential move to the upside. It gives you greater confidence in your charting, greater confidence in the confluence of information that we're seeing in the markets and the potential movements that we are going to see to the upside. So we're seeing the currency breakout already. That's what's in the circle there. It says Swiss franc's consolidating above its early breakout line, but right below its final breakout line. And silver's right there behind it. Same market conditions. Pretty remarkable that we're now 10 months into 6+% mortgage rates without an appreciable fall in construction-related employment. There are more people working in single-family construction now than at this time last year. So again, one of the things that we can look at is the state of the real estate market. The shape of construction job growth is still very strong. So I think that we are still booming in construction, and we'll see what the housing starts numbers look like. This is gross stock valuation. Okay, I think we actually went over this already, so I'm going to stop it there because I went over that before. That's what we're seeing in the markets right now. If you guys like this information, give me a thumb up, subscribe to the channel, subscribe to the website if you'd like. Overall, guys, everything's still intact. The valuations are there. So again, the three pillars. It's ratios, technical analysis, and market conditions. Those are the three pillars. Market conditions are still ripe for this to occur, given where we are in the real estate cycle and all that stuff, inflation. Could we have a slowdown in the middle of the cycle? Yeah, it's secular versus cyclical. Secular is the big move, cyclical is the smaller moves that happen in the secular shifts. So you can have a recession in the middle of a secular bull market in commodities, where commodities just go straight up. To me, a lot of the charts, if you look at technicals, still look very good for commodities. You can look at ratio charts. You can look at individual charts that are measured in dollars of certain sectors, like we did today with oil, natural gas, and some of these other commodities. They all look good, and they're doing retest moves where I think they could potentially head higher. And then we've got the ratios, and the ratios are all still incredibly cheap. Just like when you're looking at Trader Ferg talking about the commodity stock ratio being at a very low level, have to increase over 700% just to get back to the median valuation price against stocks. All of this is going to unwind. I think we went to a very low level, and I think it's all going to wind to a very high level at the end of the bull market, which may take 8 to 10 years, something on the lines of that. Maybe it happens a little bit quicker, 5 years or something like that. We're talking major moves. I'm not talking 20% gains. Put 2 zeros on the back of it. Maybe 2,000% gains, 5,000% gains, 10,000% gains in some of the companies if you can find them and they hit something during a big bull market. But that's what we've got for today, guys. So we'll leave it there. And we'll catch you guys later. This is Finding Value.